Alongside shares, bonds are one of the two key asset classes for stock market investors. So what are bonds, and why do we invest in them? This is Bonds Explained by the Simple Economy. A bond is what a company or a government sell to the public in order to raise money. You buy their bond, and in return, they promise to pay you a fixed interest amount each year for the agreed life of the bond. And at the end of the bond's life, you get your original investment back. So a bond agreement is essentially a loan that you make to a company or a government. Just like a bank, you must now make a judgment to decide if you want to take the risk by loaning money to them. You have to judge if you think they will be able to pay you your money back. The riskier the bond, the more return you could potentially achieve. Loaning money to a government like the UK government is seen as virtually risk-free, given they are not expected to go bankrupt and have never failed to pay the money back in the past. Because it is less risky, the interest rate you receive from the bond is relatively low. You can usually achieve a higher return by loaning money to a company. However, this is riskier because companies can go bankrupt, and in that scenario, they may not be able to pay you your money back. For that reason, the return will be relatively higher in order for it to be worthwhile to take the risk. That being said, buying the bonds of a company is still seen as safer than buying its shares. This is because bondholders take priority in getting paid, with the company legally obliged to pay them the agreed amount. Bondholders are some of the first in line to receive their money from the company, while shareholders are last in line. Shareholders will only receive what's left over. So we now know that a company or a government issue bonds to raise money. Companies want money to fund spending on growing the business, on things like new equipment or a new truck, whilst the government wants your money to fund spending on the country, like new schools or new hospitals. We will explain government bonds further in another video, but for now we will explain bonds from the point of view of a business. And if a business wants to raise money, they have two main options: selling ownership in the business by selling shares, or borrowing money by selling bonds. So going back to our example of my company, Ben's Brollies, let's explain the process the company has to go through in order to sell bonds. Firstly, the board of directors would get together and decide on what return the bonds will pay and what the length of the bonds will be. Let's say the board decide that they will sell a bond that pays a 5% return to investors for a period of 5 years. As is the norm, each bond will cost £100 each. They decide to sell 4 of these bonds in order to raise £400. So if you bought one of the bonds, you have now essentially loaned £100 to the business. The bond is an investment for you, as it will provide £5 every year for the next 5 years, and pay the original £100 back at the end of the 5 years. From the business's point of view, they receive your £100 which they can now use to invest into the business. For example, buying more stock or buying that new truck. The bond is, however, a debt that they must now pay back. They must ensure they have enough cash to pay you your £5 in interest for the next 5 years, and they must also look ahead and ensure they can pay you the original £100 back in 5 years' time. So for the business, the advantage of bonds is that the business owners don't have to give up part of their ownership. If you are the sole owner of the company, you get to keep 100% of the profits. The disadvantage, however, is that you now have debt to pay back, and you are obligated to pay interest to the bondholders every year. And for the investor, the advantage of bonds is that they pay a guaranteed fixed amount each year with the original investment paid back at the end. The disadvantage is that their return is limited, so if the company becomes hugely successful, they will still only receive the agreed fixed payments, whilst the shareholders have unlimited upside. Thanks everybody for watching. Please do like the video if you found it helpful, and please do leave any comments or questions below.